If you were to survey any group of traders, you would undoubtedly encounter a very diverse population. They would have differing methodologies, different techniques, they would have different backgrounds, they would trade different markets, they would trade different timeframes. But the one thing they would all have in common is this notion of an edge, something that enables them to be profitable over time. Unfortunately, in trading, this notion of an edge has become something of a throwaway line where people will go, well, you simply need an edge. Well, yes, that's a given, but it doesn't move you any closer to understanding what an edge is, defining it, or more practically working out what an edge might be. So in this video, what I'm going to do is define what an edge is, and I'll then look at a very practical application of an edge, and then look at two techniques that you can apply in trading which generate or contribute to an edge. So in terms of a definition, my definition of an edge is this. An edge is any component of a system or individual that produces a quantifiable advantage over time. You'll notice I've included the word individual here. Many people think that an edge is simply a function of the mechanistic aspects of a trading system. I actually think the definition is more nuanced than that and much broader. It is quite possible to have an individual who has, I won't say an ordinary system, but a system that is lackluster. But what makes them profitable is their rigorous and ruthless application of the system. And it is that application, irrespective of the state of their equity curve, that makes them profitable. So we come to this key point. Quantifiable equals profitable. Your edge must generate profit. It must generate money. Otherwise, you're simply relying upon luck. And this is not something you want to do as a trader. So I mentioned in the introduction I would look at a real-world edge that applies to a given endeavor. And the one I want to pick is professional basketball, simply because the edge is so apparent and its application has such ramifications for those attempting to partake in this environment. So I've got some statistics here. So if you are an average height US male, somewhere between 5'8", 5'10", or 170 to 177 centimetres, then you have a 1 in 3.8 million chance of playing in the NBA. So if you're of average height, your chances of playing in the NBA are 3.8 million to 1 against you. However, if you're over 7 foot tall, which is a remarkable 213 centimetres, then you have a 1 in 7 chance of reaching the NBA. Here, height is the edge. It is definable, quantifiable, and it is also profitable. This edge can be broken down a little bit further. Every inch you gain in height doubles your chances of playing in the NBA. So if you're 6'5" or 195 centimetres, you have double the chance of someone who is 6'4". And this relationship persists all the way to 7 feet tall, where it begins to break down. So what is the application of this in trading? Well, it is finding something that makes a difference and something that is quantifiable and allows you to apply it to your trading. So in trading, your edge may relate to either market selection, technical execution, money management, or, as I said before, psychology. You can find it in any one of those domains. And to have a look at how edges work in trading, most people are familiar with this little graphic. This little graphic shows you that if you had missed the 10 best days in the S&P 500, your return on $10,000 invested across this period would have only been $32,665. Missed the best 20, it's $20,000. Missed the best 30, it's $13,000. The argument here is to be found in the bar on the extreme left. It says you must be fully invested. And so for these people, their edge would be that you are fully invested. And the unfortunate thing is that's not an edge. And this chart misses out on a very important component of trading, and that is that there are periods when the market goes down. So simply looking at the best days does not tell us the entire story. To look at the entirety of returns, you actually have to look at best days, fully invested days, and also worst days. So what I did was I generated a similar graphic for the ASX 200. And what I've done here is I've said what happens to our returns if we miss given periods. So the first line to concentrate on is the blue line. This is our control. This is what you would get in terms of returns. This is what your equity curve would look like if you were fully invested, and you were fully invested at the start and you made no alterations to that. The red line is that period whereby you had missed those days where the market had gone up by 3% or more. And you can see it has a detrimental effect on the account. But as I said, there was something missing. And the thing that is missing is that what happens if we're not in the market when the market goes down by 3% or more? And what we see is the green line. You can see that the returns from missing the bad periods are far superior to being fully invested. There's a reason why this happens, and it happens because of a quirk in financial mathematics. If I lose 10% of my capital, making 10% on what I have left will not get me back to my point of origin. I need to make 11.1%. And if you graph this recovery curve that you need for each of these losses, what you build is an exponential curve that you cannot recover from. It is immensely hard to get losses back. So as an overall strategy, you are better off playing a defensive game and avoiding those periods where the market has these clusters of very poor returns. So our first edge is a simple one. It is only buy equities when the overall market is trending up. Strangely enough, this is remarkably controversial. This, for some reason, elicits an enormous amount of pushback from people. And my argument is a simple one. Don't argue with me, argue with the data. And strangely enough, the argument ends at that point, because you can't argue with the data, because financial mathematics is a very fixed domain. You can refer back to this little graphic all you want, but the problem is it only tells half the story. This graphic tells the entire story, the reality of investing, the reality of trading. Markets don't always go up. They have periods where they go down, and you need not be involved in markets during those periods, because not only are you running the risk of incurring losses, you're also generating an opportunity cost. You have capital tied up in markets where nothing is happening, but something might be happening somewhere else. This is the wonderful thing about markets. They're spread across instruments such as equities, indices, FX, commodities or futures, crypto. There's a vast array of instruments that you can participate in. You don't have to be stuck in an equities market, irrespective of what a financial planner tells you. So we return to this as a conclusion. You only buy equities when the overall market is trending up. And as I said, it sounds blindingly obvious, but to each and every fund manager in Australia and those who manage your superannuation, it is not. And it in part explains their very poor returns for you. The other one relates to this notion of individual instruments. So this is the notion of an edge that is accrued by having a particular view of markets and portfolio management. This is a chart of cocoa, and it's a weekly chart. Cocoa is a commodity. And this is the chart of the futures contract. And as you can see from December 22, it has been in this wonderfully powerful trend. And so the long-term trend is up. If I compress this to a daily, this is the period I want to concentrate in. This is the period when it began to really accelerate. And all I've done here, you'll see a series of blue and red arrows. The blue and red arrows are simply a breakout system, and it's a 20-day high or low. It's very, very simple. It's only on there to give you an indication of the strength of the trend. You get an indication of the strength of the trend simply because you get one new high after another, and these new highs aggregate. You will see in early 2024 there is a reversal signal which appears on the short term but not the long term, so it's an irrelevancy. Market then takes off again and runs from about 39.50, 4,000 up to the terminal point on this chart, 6,800 or thereabouts. So very strong trend. But the thing to note, I've plotted volume along the bottom of this chart. Volume in futures trading is a little bit more complex than it is in equities, because there can be a variety of reasons why someone is selling. You may sell to open, you may sell to close. The futures markets have this idea of novation or contract substitution. It's what enables futures markets to actually function. But if we opt for a very simple analysis, you can see that even during the strongest part of this trend, there will be people who had bought to open, who are long, and who are selling to close. They're closing the position out. And the question has to be asked as to why they're doing that. And as I said, volume in futures is a little bit more complex, but the overall pattern of behavior of traders remains the same. And that is that traders simply look to take very, very small profits. It's been found in futures markets that the motivation of traders is not one of profitability, it is entertainment, so they seek the turnover. So what they're doing is completely ignoring this background chart that says cocoa has been going up for some time and it is now accelerating. And we come back to our daily chart with all our little blue arrows. And each one of those little blue arrows is the market saying to you, do you wish to be involved, yes or no? And it continues to ask that question over and over again. And as we can see by the volume going through the market, there are hosts of individuals saying, yes, I can see you're telling me that you're going up and you're offering me this opportunity. No, I don't wish to be involved. That is the illogical nature of traders. So we come to our second rule for an edge, and that is only buy an instrument when it is trending up over a higher time frame. This is also something that gets a little bit of a pushback. And it gets pushed back because people don't understand the long-term nature of trends or the fact that markets trend over a variety of time frames. And this applies equally to people who trade 30-minute charts as to those who trade daily. You look at the higher time frame and to see where the impulse of the move is coming from. Effectively, what you're doing is you are looking at who is in charge. Because all of trading boils down to the very, very simple question, who is in charge? Is it the bulls or the bears? And so you have to have a mechanism of telling you who is in charge. Once you're able to define that, and you can define it not only over the time frame you were trading, but the next one, you have this notion of momentum carrying you forward. And all of a sudden, you've built an edge simply because you understand who's in charge and you understand what the momentum of the market is. There will be people who have looked at this chart, particularly in the period from, let's say, February on, who've looked at that and gone, that's going down, I will short cocoa. Which bears no resemblance to what is happening on the chart, but that is simply because people refuse to accept who's in charge. When we look at this chart, the bulls are in charge. And when we drop back to the weekly time frame, this is reinforced for us. So within the weekly chart, what we're looking for are signals to go along with the daily if we trade this instrument over a daily time frame. So simply to repeat, you only buy an instrument when it is trending up over a higher time frame. We come back to this rather blunt summary of the video, and it's quite simple. If you have no edge, you have no profit. There is no way to get around that. You need some form of positive expectancy in your trading. And if you do not have that positive expectancy on average over time, then you have absolutely no hope of making money.